Welcome everyone to this evening's webinar. Our topic for this evening is Solo 401k, the ultimate retirement plan. My name is Natalie with Sense Financial. We are a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. Since 2010, we have assisted over 3,000 clients and established more than 4,000 self-directed retirement plans. And it's great to see many of our clients joining us today. If you are not part of the Sense Financial family, we would be happy to set you up with a complimentary consultation to discuss how you could be control in your retirement savings. If you have any questions that come up during this webinar, feel free to type them up in the chat area, and we will try our very best to get through all of them at the end of the presentation. But today our presenter is Dmitriy Fomichenko. And before he starts the presentation, I would like to give a brief introduction. Dmitriy is the founder and the president of Sense Financial Services, LLC, and he holds designation of Certified IRA Services Professional by American Bankers Association. He began his career in financial planning and real estate investing back in 2000. Today, he's a licensed California real estate broker and investor, and he's also a private lender. Over the years, he's taught hundreds of investment and financial planning seminars, and he's mentored thousands of investors. And just a quick disclaimer, Sense Financial Services LLC is not a fiduciary, and it does not provide legal, tax, investment, accounting, or other professional advice. If legal, tax, investment, accounting, or other expert assistance is needed, please use services of competent professionals. But once again, welcome, Dmitriy, and I will hand everything over to you.
Thank you, Natalie, for a great intro. Can you hear me okay?
Yes, everything sounds good.
Okay, awesome. Well, thank you so much again, and just wanted to welcome everyone. Thank you for joining us for tonight's presentation on the topic of a solo 401k, which is the ultimate retirement plan. And let me go ahead and jump in. And in the beginning, just wanted to quickly share our mission, why we exist. And we exist to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we know that you work hard for your money, so we want to come alongside you and help you on your journey to securing your future and achieving financial independence. Well, if you just like many people out there who are investing in the stock market and watching their 401k account shrinking, you might be like this couple in this cartoon. Credit goes to my daughter, Giselle, but a man says, I finally decided to put something aside for our retirement, which is our plans to retire. Well, if your 401k account is shrinking, no wonder you can put aside your plans to retire. But the good news is you do have alternatives. And the stock market is not the only investment option, which is, frankly, you and I have no control over. But there are some alternative investment options that can significantly improve the results for you. We'll be talking about self-directed solo 401k plan. And first, I wanted to just give you a general understanding and the overview to compare a conventional retirement account with a self-directed. A conventional retirement account is held by the custodian. Some of the big names are Schwab, Fidelity, Merrill Lynch, and so on. And the investment options are always confined to the stock market. So you basically can only buy some stocks, bonds, and mutual funds. As I mentioned earlier, and I'm sure many of you will agree with me, that we don't have control over the stock market. We can perhaps employ certain strategies that will help us, but ultimately we don't have full control over the retirement account that is invested in the stock market. Well, the alternative is self-directed retirement plan, whether self-directed IRA or self-directed 401k, which enables you to invest in alternative assets. And what you see here on the list under self-directed is just some of the most common investment options, such as real estate, tax liens, tax deeds, options, mortgage notes, trust deeds, private business and partnership. You can invest in real estate internationally. You can then do private lending, use your 401k as a bank, and you can also do conventional retirement accounts as well. So as you can see, this is not an exhaustive list by any means. Those are just some of the most common investments. In fact, if someone is telling you that they have an investment that is approved by the IRS, actually that's not true, because IRS doesn't approve any investments. IRS says that you can invest in pretty much anything with certain limitation. There are certain restrictions. You gotta follow certain rules, which we'll go over. But again, the investment options virtually limitless with self-directed account. When it comes to self-directed options, you have basically three options. There is a self-directed IRA, that is also known as a custodial IRA, held by the custodian. You control the account, so you tell the custodian how to invest, and they invest for you, but they act as a middleman. There is a checkbook IRA, or known as a IRA LLC. Essentially, this is a self-directed IRA on steroids, which this structure enables you to bypass the custodian. You cannot avoid the custodian with an IRA, but you can bypass the custodian by utilizing a checkbook IRA structure. And last but not least is a self-directed solo 401k, which is also known as the ultimate retirement plan, because it has a number of significant benefits over an IRA or self-directed IRA in particular. You don't need a custodian with that. You don't need LLC to get the checkbook control. And there's a number of other advantages, and we'll dive into each one of those shortly here. But first, what is a self-directed IRA? Essentially, it is a tax-deferred trust account held by the IRS-approved custodian, which allows you to invest in non-traditional assets. They've been around since 1974. They are very little known because your stockbroker and your financial advisor not interested in you knowing about that, because they want you to keep investing with them. That's how they generate profit off of you investing in traditional investments. But the truth is, some of them even don't know that self-directed IRA even exists. Some of them don't even know that you can use your IRA to invest in real estate. But millions of Americans took advantage of this, and so can you as well. The benefits of a self-directed IRA: it allows you to invest in non-traditional assets. It allows you to achieve true diversification. The investment returns, if you invest in real estate, for example, or do private lending, they're sheltered from taxes because it is a tax shelter. IRA is a tax shelter. It's tax deferred vehicle. If you invest personally, you have to pay taxes on the profit in a year in which profit is generated. But inside of an IRA, all of the gains, taxes, and profits and incomes are sheltered from taxes. And you can also use leverage when it comes to real estate by using non-recourse loan. To help you better understand the concept, I wanted to give you an example. Jason is one of our earlier clients, and I like to use his example because I think most people can relate to him. Before coming to Sense Financial, he had a couple of retirement accounts, an IRA and a 401k from the past employer valued about $135,000. Just like many of you today, he was watching the balance in his accounts going down because he was losing money in the stock market. So he ended up liquidating everything, just moving everything to cash. He wanted to cut his losses, started doing his research. He found us online, contacted. I remember doing a consultation with Jason, and we were able to establish a self-directed solo 401k plan with checkbook control for him. And he made 3 investments at that time. He purchased a rental property. He invested portion of the money in his brother's business. His brother was a serial entrepreneur and started several businesses successfully. This was his another venture. And he also invested in a note. He actually in a real estate note, so it is a secured note. He used his 401k as a bank by lending money to a borrower who needed that loan, and that loan was secured by real estate. So immediately he started cash flowing, and since then it's probably more than doubled because it's been over 10 years ago when he did that. So his cash flow, immediately he started realizing a cash flow, and immediately he had assets that were producing steady passive income and assets that were appreciating in value over time. So that's kind of a makeover, example of a makeover that we do for our clients. Now let's talk about solo 401k. What is it? Well, it's not a new plan. Essentially, it's set up under Internal Revenue Code Section 401, subsection K, which is defined as a retirement savings trust. The word solo here means that it's designed for those people who are self-employed or own a small business. So in other words, solopreneurs. Essentially, it's a simplified version of the 401k. So it's conventional 401k plan that covering the business owner and his or her spouse, essentially. So in most cases, these plans, they only have 1 or 2 participants. So there are no other non-owner employees who participate in these plans. And because of that, they're very simple to maintain and give you a lot of freedom and flexibility. It's been made possible as a result of the changes in the tax law in 2002, which was known as EGTRA. And this change made many benefits of the 401k possible. And again, we'll dive into those details in the next few slides here. But first, I wanted to address something. You may be listening this and saying, okay, it's designed for those who are self-employed. I don't qualify, so I'm gonna sign off. Well, before you do that, just pay a little bit more attention. Number one, even if you don't benefit from it now, you may benefit from it future. So it's always good to keep that in mind. But also, it's not difficult to become self-employed. Many of our clients, they do have full-time jobs, but they do have some kind of a side gig or a side business that they do something on the side, and they're able to qualify. So it can be part-time, but there are numerous benefits of being self-employed. It's easy to become one, and it comes with some benefits. You actually going to be lowering your tax bracket by being self-employed because you're going to be paying less taxes. You're going to be able to deduct your business expenses first and then pay taxes on whatever is left. You can build residual income depending on the business structure. you can be in control. You can be your own boss. So that means freedom. You can feel good about what you do. You can help other people. And that's essentially how I started this business. I guess you can call it at the right place at the right time. I saw the need, I saw the opportunity, and I came up with the solution. That's another story, but that's true story. You have the potential of making more money than being an employee, because being an employee, there is a limit. You can only make so much in salary or hourly, but being self-employed, if you do it well, you have a lot more potential. And then you also can take additional deductions by further reducing your tax liability, such as your vehicle, office, and etc. And you can have the freedom of working from home. So I remember many years ago, probably over 20 years ago, attending a conference, and there were two speakers, and these two guys, I don't remember their names, but I do remember the book that they authored. And the book was called ABCs of Making Money. And that book is still in my library today. And I actually only remember one thing from that book, and it is multiple streams of income. You want to create multiple streams of income, because if you have a job, job, guess what? You don't own that job. It's you don't control it. It's here today. It might be taken away from you tomorrow. So you do want to have multiple streams of income. So starting this side gig might be a way for you to move in that direction, and at the same time qualify for a solo 401k plan. But let's move on. Let's talk about the eligibility. I mentioned it's designed for those people who are self-employed or own a business. So let me qualify that. You must meet two criteria. Number one, you must have a presence of legitimate self-employment activity. Now, let me emphasize, it has to be legitimate. It can be a hobby. And if you want to understand the difference between a hobby and a business, you can just Google IRS hobby versus business. And there is a good article on the IRS website that explains that. Essentially, hobby is example of a hobby. You're a photographer, and you do a photo shoot, and you make a couple $100 from that, and that's it. That's your only revenue. So you pretty much didn't generate any profit, and you spent $1,000 maybe on equipment. So you didn't generate any profit. That will be example of a hobby, not a business. But if you're doing something, and you're able to generate revenue and then show some profit, at least a few $1,000s at the end of the year, then that is a business. You are in business for yourself. It can be in any type, any shape, or any form. And here I'm giving you just some examples. Being a doctor who worked for himself, maybe has a small office. An attorney, again, has his own practice. A property manager, you're managing properties for others. Not that where I'm at in California, you have to be a licensed real estate broker to do that, but that's not the case in some other states. It's even possible to manage your own properties. You can structure your own property management company. You don't have to be licensed to do that if you're managing your own properties. Talk to your CPA about this, or talk to me. I can give you some further details on that. You can be involved in some kind of network marketing business, consulting. You can be a nurse. I do have a client who actually a nurse, and he works full time for a hospital, but then he does some other nurse work on the side. That's how he qualifies. I have a number of clients who flip real estate. They buy real estate, fix it up, and then sell it for a profit. People who wholesale real estate, they find the deal, they actually put it on the contract, and then they assign a contract for a fee to somebody. So you can do it actually without money or being involved in real estate, just flipping the contracts essentially. And on and on and on. So if you generate some self-employment activity that you report on Schedule C, which is where self-employment income is reported, then you'd qualify. And then number two is the absence of full-time employees. By law, if you have employees who work more than a certain hours, it's actually 1,000 hours for the first 3 hours and then 500 hours to be precise. So if you have employees who work for you that meet this criteria, then you're required to offer them 401k benefits as well. So solo 401k is not going to work for you. So it's truly designed for those people who are either self-employed or own a business without full-time employees. So let's dig a little bit deeper into the absence of full-time employees. Designed for self-employed individuals or business owners without full-time employees, other than the business owner himself and the spouse. Leased employees will not be allowed either. You might be, if you're contracting with the maybe employment agency that leasing employees to you, they will be considered employees to you as well. So that's not going to work. They truly have to be independent contractors, or if you have employees under 21 years of age, those can be legally excluded, or those who work under 500 hours. So if you have a part-time assistant, then you can have the 401k plan. So let's take a look how it works. First and foremost, what you have to have in existence is you have to have the sponsor of the plan. And the sponsor of the plan is can be your sole proprietorship. You don't have to be incorporated, but if you are incorporated, that's fine. You can use a corporation to sponsor a 401k, LLC, or a partnership. Next, a plan sponsor adopts the plan, and the 401k plan is created, and it comes with a trust. There is also a trust that is created, and the trust essentially serves as a vehicle to hold the plan assets, and you become designated trustee of the trust, and the role of trustee is to control plan assets. So you will control the plan assets, then you will decide to make certain investment decisions. You're going to decide to buy certain property or invest in a certain loan, and then as a trustee, you have the power to open a business checking account at a bank, or you can open a brokerage account at a brokerage, and then all of the income from those investments will be going to the trust bank account. All of the expenses, such as property taxes for the rental that your 401k owns, or insurance or repairs, all those expenses that are directly related to the investment of the 401k, they must be paid from the 401k bank account. All right, so let's talk about the benefits of the solo 401k. That's probably the most exciting part. How does it benefit you? So let's take a look at that. Number one, it's a great tax shelter. It offers high contribution limits, over $60,000 a year per participant you can contribute. It's actually broken down into two parts. See, being a self-employed or a small business owner, you wear in two hats. You wear in the hat of an employee and the hat of the employer. So let's say you you have a consulting firm. Well, you own a business, so you're wearing the hat of an employer, but you also doing the work. You actually doing the consulting. You meeting with clients and you providing the consulting services. And you can contribute as board. That's why the limit is so high. And I'll go over the details in the next slide, but because it allows you to contribute as basically both the employee and the employer, you can really benefit from that. Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends wherever he gets." So it's a good application of this proverb where you can really take advantage of putting some money away, sheltering that from your taxes. So like I said, it's a great tax shelter. You get immediate benefit, but also you get to control this money, how it is invested over the next number of years until you start taking distributions from your retirement plan. So let's break it down. As an employee, you can contribute what's called elective deferrals or employee elective deferrals. And that limit for this year is $22,500 per year. Plus, if you're over 50 years of age, you can contribute additional $7,500 as a catch-up, making that total of $30,000. And if you're employed, if you have a 401k to your employer, those numbers might be familiar to you because they're identical. So it's still a 401k. The limit is the same for the employee. Now, here's where you need to note that if you have the plan at your employer, if you already participating in another employer-sponsored plan, then this contribution is a single to or is a subject to a single limit for all plans that you may be participating. So if you have the employer-sponsored 401k plan at your day job and you're contributing, say, $15,000 there to the 401k at your employer, and you also have a side business and you set up a solo 401k, as an employee, you can only contribute the balance, which is difference between 22.5 and 15, which will be 7,500. So as an employee, you can contribute 7,500 here, assuming you're under 50. If you're over 50, that's going to go up to $30,000. Now, with the solo 401k, this component can be up to 100% of your self-employed earnings. So if, let's say, you're making only $25,000, you have a side self-employment activity and you're making $25,000, and you don't necessarily need this income to live on, you can put most of this 22.5 limit, up almost 100%. But again, it is up to 100%. If that number was only, say, $15,000, then you can put $15,000 up to 100%, not to exceed 22,500 plus catch up. This applies to Roth. I'm not, I didn't talk about the Roth component yet, but this employee elective deferral, all the plans that we established, they do come with the Roth sub-account, or essentially allowing you to make either pre-tax elective deferrals or Roth deferrals. So this amount can be contributed after you pay tax into the Roth bucket, which can then be invested tax-free for the rest of your life. The second component is the employer profit sharing contribution. This is always tax deferred. So this is always deduction for the business. This is always an expense item. Unlike employee elective deferral, you can choose to make after-tax contribution. The profit sharing component is always pre-tax. It's always a deduction for the business. And it is up to 25% of self-employed compensation. However, if you are, if your business is sole proprietorship, or if it's a single member LLC, which taxed as a pass-through entity, essentially sole proprietorship also, then that's 20% of your net self-employment compensation, because that difference goes to cover self-employment taxes. And the total limit for this year, for 2023, is $66,000. Again, that's the combination of the employee elective deferrals, 22,500, plus the profit sharing up to 20 to 25%, depending on your business structure. The combination of the two is not to exceed $66,000. And if you are over 50 years of age, then you get to benefit from additional $7,500 in catch-up contribution, bringing it up to $73,000 in total contribution. I mean, the benefit of this can be just tremendous. Think about this: if you are running successful business, if you're doing well, and if you get if your spouse is involved in the business, or if you want to get your spouse involved in the business, then you can double your contribution limit. You can double those amounts. I mean, think about this: if you're able to shelter together with your spouse over $120,000 of your income from taxes, well, what you've done immediately is you immediately were able to drop your taxable bracket to maybe one or two brackets down. So you're going to be in a lower tax bracket, and you're going to be paying a significantly lower dollar amount in a lower tax bracket. So the savings can be, depending again on how much you contribute, can be $20, $30, $40,000 potentially in tax savings. So that's huge. And this is immediate benefit. We're not even talking about the future benefits, how you get to invest this money and how it will benefit you in the future. But this is immediate benefit that you take advantage of today. Pretty much in a year that you contribute, you're saving on taxes, you're keeping more money in your pocket. Next benefit is the ability to take a participant loan. This is like another way to describe that is you have your own line of credit, okay? Or you have your own bank that will never turn you down, because you're the one applying and you're the one who approving that application for a loan. Okay, now let's take a look at some of the details. This loan is available to all the participants of the 401k plan. So essentially, if you and your spouse participate, each one of you can take a participant loan from his or her respective account. The amortization is 5 years. So the loan has to be amortized over a period of 5 years. And if you're using the loan to purchase a primary residence, then the loan can be extended to 15 years. Otherwise, it's always 5 years. And it has to be amortized. So you're making payments using principal and interest. So there is no option to defer payments or to pay interest only. It has to be amortized over a period of 5 years. You can choose to make payments either monthly or quarterly. So you choose that at the time of the loan, and then it stays that way, but you do have that flexibility at the time of applying for a loan. You are paying interest back to your own 401k, and the interest rate is set at prime plus 1%. So you're not paying to some bank, because remember, you're borrowing from your own 401k and you're making payments back to your 401k. So your 401k is actually benefiting. One example comes to mind. I remember I had a client who had a high interest medical debt, like over 20% that she was paying. And she was considering cashing out her IRA. I think she needed $10,000 to pay that off. And after meeting with her CPA, she was told to pull out $20,000 because she will owe about $10,000 in taxes on that premature distribution. Because when you take distribution from your IRA or from your 401k before normal retirement age, not only it becomes taxable event, which also can kick you up to a higher tax bracket, but you also have to pay penalties on the federal level and depending on your state, on the state level as well. So she was told to pull out the double because she would lose about half of it in taxes. Well, after we met and we talked about her situation, she had a side gig. She was able to qualify for solo 401k. She rolled over that IRA into a solo 401k, and she ended up taking only $10,000 loan. And there was no distribution. It wasn't a taxable event, and she started making payments to her own retirement account instead of to this, lender who was charging her super high interest rate. And you can use this loan for any purpose, pretty much. There is no restrictions how you can use the loan. But this feature allows you to access up to $50,000 or 50% of the balance in your 401k, whichever is less, without taxes and penalties. Another thing to keep in mind is that occasionally people talk to me and they consider a certain transaction that after digging into that, it appears to be a prohibited transaction. It's not allowed transaction for the IRA, but you actually can use a participant loan to execute a transaction that otherwise will be a prohibited transaction. So again, you're creating your own bank that will never turn you down for this loan. And it's not possible to get a loan from an IRA. IRA doesn't have loans. If the only way to tap into funds in an IRA is to take a distribution, which again comes with taxes and penalties for premature distributions. Next, as I mentioned earlier, each plan that we establish, so each one of our clients who have a solo 401k plan will have this Roth component or Roth provision, which allows you to make contributions after you pay the taxes into Roth sub account. And note that there is no income restrictions for the Roth 401k contributions. Unlike with the Roth IRA, if your income is over a certain threshold, you're not eligible to contribute to a Roth IRA. With solo 401k, there is no restrictions on your income. You can contribute regardless. The limit on the contribution is 22,500 plus. If you're over 50, then it extended to $20,000 with the catch up. And with the Roth IRA, that limit is maximum $7,500. All income and gains that are generated inside of a Roth 401k account will be tax-free potentially for you if you don't touch this until you start taking qualified distributions from the Roth 401k account. You can actually access your contributions at any time because you already pay taxes on the contributions, so you can pull them out at any time. And if you have pre-tax funds, or maybe if you have a rollover IRA that you want to move into a 401k and then perform a Roth conversion, you can do so. The Roth provision allows you to convert your pre-tax funds into the Roth account. This is a taxable event, but think of it this way. Would you rather pay taxes on the seed that you're planting or on the harvest later when you reap the harvest? So certainly makes sense, and it's not a one size fits all, but certainly makes sense for some in some cases. This plan is very cost effective because There is no custodian, as I mentioned. You don't need a custodian, unlike with an IRA. So that means that you eliminate custodian fees forever. There is no red tape or delays. If you have a self-directed IRA, you have to go through the custodian for each transaction, pay the fee for that transaction, and then there's a lot of red tape. You have to go through certain steps to get the transaction approved, and sometimes it gets tuned down, and you don't have that. So you can execute that quickly. You serve as the trustee of your 401k plan. That means that you are in control, so you can act quickly. How quickly? Well, literally as quickly as writing a check. That's how quickly you can execute a transaction. They're easy to operate because there is no annual reporting until your plan reaches or total plan assets reach $250,000 in plan assets. Until then, you're not required to do any reporting for the plan. Once you reach that threshold, it's very simple form actually. It's called the short form 5500 EZ, and we do help you complete that form. So that's part of the service that we offer. You can invest in real estate with your self-directed solo 401k plan. All the income and gains generated by your 401k accounts are sheltered from taxes. All the you pay taxes at the future date rather than in the year in which the investment income is produced. The real estate gains and income that are generated inside of a Roth account are actually tax-free. And again, it's very important that all the income that generated by investments of the 401k goes back to the 401k, and all of the expenses that are directly related to the investment that 401k owns must be paid from the 401k account. You also can use leverage when you purchase investment real estate in your solo 401k. But because you're a disqualified person, you're not allowed to provide a personal guarantee. Loan must be non-recourse, which means, again, there is no personal guarantee. Property will serve as the only security for the loan. Typically, these lenders require 30 to 40%, 30 to 50% down. Property must have sufficient cash flow so that it produces enough income to pay or service the debt. And you must also have reserves. If you did that inside of an IRA, it will trigger UDFI, which is unrelated debt finance income. 401k is exempt from this, from tax on this income. And there's only select lenders and banks that specialize in these types of loans. And we do have a list of lenders, including our preferred lender, which is the best, offers the best programs, Letter Bank. You can find them at this link, SenseFinancial.com/non-recourse lenders. So let me spell out a UDFI a little bit further for you. When you invest in real estate, the leveraged portion of the investment produced what's called a unrelated debt finance income, because it is produced from a portion of the property that is financed. Inside of an IRA, UDFI triggers UBIT, or unrelated business income tax. And the current tax rate on this is about 37%. It's in the sliding scale, so it starts lower, but it creeps up to 37% eventually. And 401k is exempt from the tax on leveraged real estate. It is not exempt from UBIT period. Some people mistakenly or mistaken by this. I've seen some comments online that 401k is exempt from UBIT. It is not. It's exempt from UBIT on leveraged real estate only. All right, moving on. Another benefit that it allows you to actually pull other retirement accounts into your solo 401k. So if you have other accounts such as traditional IRA or 401k from a previous employer, you can move those by performing a direct rollover from that plan into this new plan. Please note that Roth IRA is the only exception. IRS does not allow you to move Roth IRA into 401k. So that's the only retirement plan that cannot be moved into the solo 401k. And if we're talking about employer-sponsored plans such as 403b, 457, 401k, typically it has to be from the previous employer. Because again, typically there are some exceptions, but generally as a rule, if you have a 401k with the current employer, you're not allowed to touch that until you leave the employer. The bottom line, self-directed solo 401k allows you to invest in virtually anything: real estate, residential, commercial, tax liens, tax deeds, precious metals, bitcoins. You can invest in a private business, and you can be the bank and lend money to others. A true diversification means you will avoid this. The picture here of a man holding the basket, which has bottom fell off and all the eggs are gone. They're broken. And the wife says, well, I thought that our investments were diversified. Well, guess what? If you're just in a single asset class, such as stock market, then you're not truly diversified. It's just in a single asset class, and you can lose all of the eggs in that single basket. So you want to have multiple baskets, and you can accomplish that with the self-directed solo 401k plan. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. And I think all of you have seen that. We've been through 2007 crash in the market and real estate in the stock market, and also real estate market. We've been through last few years in the beginning of pandemic, where the market took a significant dive as well. So you've seen that. Definitely there is wisdom in these words here. But let's talk about the limitations, what it is that is not allowed. There's a lot of things you can do, but there are certain restrictions. Disallowed investment as defined in the Internal Revenue Code section 4975, which is a code that explains prohibited transaction rules, states that you cannot invest your 401k in collectibles, and that's pretty much the only investment. And also S corporation. The reason for the S corporation here is because in order to be a shareholder of a S corporation, you have to be a physical person. So an entity cannot be part of the S corporation. Don't misunderstand me. If you have a business that is an S corporation, your S corporation can adopt a solo 401k plan. It just the solo 401k plan cannot invest into another S corporation. C corporation, fine, not S corp. But again, any type of business can adopt a solo 401k plan. Additionally, this section defines a disqualified person, which is yourself, the account owner, and your spouse, your ancestors and legal descendants and their spouses, any entity in which disqualified person holds a controlling equity or management interest. So that group of people considered disqualified, and I like to just to easily remember that is a vertical line. So your parents, grandparents, kids, grandkids, and your spouse. You may think your spouse is not vertical, but your spouse and you're one. The Bible says two shall become one. So your spouse is not sideways. Spouse is part of you. Spouse is a disqualified person. but your brother and sister and cousins, uncle, aunt, those are sideways. You can go sideways. They're not considered disqualified. Well, to summarize prohibited transactions, which is this. It's any sale, exchange, or leasing of a property between a plan and a disqualified person. Lending of money or extension of credit between a plan and a disqualified person. Providing goods, services, or facilities between a plan and a disqualified person. Transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. Any act by a disqualified person who's a fiduciary or he deals with the income or assets of the plan for his own interest. And finally, receiving any consideration for your own personal account by a disqualified person who's a fiduciary from any party dealing with the plan in connection with the transaction involving the income or assets of the plan. Before I jump on this, to summarize this, the transaction that your 401k is getting involved in must be arm's length. So arm's length is a term meaning that neither you nor your immediate family members can be part of that transaction in any way, directly or indirectly. You have to be arm's length away from that transaction. So let's take a look at some examples. Engaging in transaction directly or indirectly with a disqualified person. Example can be buying a property from a disqualified person. Some people ask me, I own a investment property, can I transfer that to my solo 401k? No, because that will be a transaction between disqualified person and a plan. That is prohibited. Using 401k as a security for a loan is prohibited. Providing a guarantee for the loan to the 401k is prohibited. That's why you cannot use conventional financing. It has to be non-recourse loan. You cannot do any loans between IRA or 401k and disqualified person. Selling personal assets to a 401k not allowed. Investing in a business in which a plan participant or any other disqualified person has 50% or greater ownership. Receiving any consideration for your own personal account in connection with the transaction involving the income or assets of the plan. And good example for that, which is a common example, if you own a property, if you're a real estate agent and you are considering buying a investment property in a 401k, you cannot be acting as an agent on that transaction. It's a prohibited transaction times two, because number one, you're receiving compensation as a commission, and then number two, you're providing services to the plan, which is again prohibited. And then you have to keep your plan assets separate from your personal. Any commingling of the funds between the plan and the personal accounts are prohibited. And I'm going to conclude this with this. If you feel like these folks who are riding the roller coaster and it reminds them of the stock market, which is true. My daughter actually, she was looking, my daughter is 16 now, and she was probably 6 or 7 when she did this cartoon for me back then. And obviously she didn't realize or she didn't understand this, but she looked at it today and said, oh, now I understand this, because stock market going up and down. Well, your investment shouldn't be going up and down. There are some alternative investments that can provide much greater stability for you, and you can accomplish that with the solo 401k plan. Well, folks, I'm almost done here. It's been a lot of information. I'm sure you probably have some questions. We'll almost the hour is over, so we'll try to take some questions, but I do want to extend this offer to you because it's been a lot of information. I try to cram it and I try to go as detailed as possible, but still we had limited time and everyone's situation is unique. So I would like to extend this offer for you. I can talk to you one-on-one about your specific situation. You can go to this URL and you can access my calendar in real time, and you can block the time that is convenient for you. Thank you um, for joining us today. This is our contact information, phone number. Feel free to give us a call to schedule consultation, or if you prefer to contact us via email, you certainly can do so. Again, thank you so much for joining, and I do look forward to speaking with you soon. And I'm gonna get it back to Natalie, who's gonna read some questions for us. Let's see if we can get at least a couple of questions squeezed in.
Yes, we do have two. The first one is from Manish. Can you invest in your brother's business?
Yes, you can, because your brother is not a disqualified person. So yes, you can invest in your brother's business, but this is a general answer without me knowing all of the details. So we need to dig a little bit deeper, assuming this is a arm's length transaction, because if I start digging deeper and you tell me, well, I want to invest in my brother's business and he's going to do this for me. He's going to, lend money to, on a property that I'm going to buy in my 401k. So this will then seem like a quid pro quo transaction. Then that's not going to work. But if it's just a truly arm's length transaction that you're lending to your brother's business, you can do so. Your brother is not a disqualified person.
Next question is if I have income on line 1 of a K1 side business and a W2 job, will I qualify for a solo 401k?
Well, if you are referring to a K1 from a partnership, and that is a business, and you're receiving your portion of the business, which I believe it should be reported on a Schedule C, then yes, you will qualify. Again, I'm not 100% sure. I'm not expert in a K1, but how that business is reported, because K1 can report different types of businesses. Now, you did specify here side business, so I'm assuming it is an active business. It is earned income. If it's reported on a Schedule C, then yes, you should be able to qualify. It has to be earned income from a legitimate business. You may also want to double check with your CPA. But again, if it's a business and it just let's say two of you, and there's no other employees, then you should be able to qualify.
Okay, another question from Manish. If I buy single family residence with non-recourse loan leverage, then if I hire an engineer to make plans for apartments, and if I hire general contractors to build, will that be okay?
If you buy a single family residence with non-recourse leverage, yeah, you can do that. And if then I hire an engineer to make plans from. So are you, I guess the question is, if you buy a single family resident and then you want to build additional apartment on that, yeah, that's possible. You should be able to do that. You should be able to do some additional construction on the property. Everything has to be handled on the 401k level. So 401k owns the property. You as the trustee of the 401k trust control it. So you hire the engineer and the contractor, you pay them, and you have to pay them from the 401k. So that should be okay. On surface, it looks fine.
Okay, from Agatha, can you move QDRO money to solo 401k?
You should be able to, and I believe what you're referring to is qualified QDRO. That has to do something with the divorce. So if you're receiving funds from, let's say, if you're going or if you've gone through divorce and you have funds from your ex-spouse retirement account that are coming to you, then you should be able to roll that over into solo 401k. Yes.
Okay, next question's from Wade. Can I have two jobs, a W-2 and be self-employed and utilize a solo 401k?
Yes, you can. You can have your normal full-time W-2 employment, and then you can have uh, your self-employment. So it's not a job. That's not a second job. That's self-employment. So I guess what you meant, Wade, is can you have a job and the self-employment? Can you have two 401ks? Yes, you can have two 401ks. You can have three 401ks, even possible. It's not common. I haven't seen that, but two 401ks certainly common. We do have a number of clients who are employed. They have 401k at their employer, and they also have some kind of a side business or self-employment gig, and they have a solo 401k for that, and they have both plans and they contribute to both plans. Yes, that is possible.
And another question from Agatha. Can you buy a rental property under your solo 401k trust directly, or do you have to form an LLC under the 401 solo 401k trust?
No, you do not need to form an LLC. Your 401k trust can hold the property. It can hold a brokerage account. It can have exchange account to buy cryptocurrency. Your 401k trust can lend money. Uh, one nuance is this. Not all states recognize the trust and allow trust to take the title to the property. Uh, for example, I know California and Arizona do that. So if you wish to purchase a property in one of the states, then the title, because normally you will take the title to the property in the name of the 401k trust. It will be something like ABC 401k trust, whatever the name of your 401k. But if you're in one of those states, and that's the title company during the the escrow process, they will help you do that, and we can provide guidance on that as well. But the title will be taken, or you as the trustee of the 401k trust will take the title. So it will be something like this. Uh, John Smith as a trustee for ABC 401k trust, or something similar to that. Um, but again, you don't have to have an LLC. The trust can own assets. That's the purpose of the trust. The trust was created for that purpose, to hold assets of the 401k.
Okay, well, that concludes today's webinar. Thank you, everyone, for joining us. We do have an upcoming Q&A session this Monday, May 8th at 11 a.m. Pacific Standard Time. So if you have any questions that come up regarding self-directed IRA or solo 401k, please don't hesitate to ask and register for that session. You can submit your question when you register or send in questions during the session. And if you're watching this on YouTube, please give it a like and subscribe to our channel and share this video with others who can learn from it. But feel free to contact our office if we can assist you in any way, and hope you all have a wonderful evening.
Thank you for joining us. If it was helpful, again, like this video on YouTube and uh, ask a question. If you think of a question that we didn't address here or something wasn't clear, ask a question in the comment, and I'll be happy to personally jump in and answer that, and others can learn from that as well. But again, thank you for joining us, and you have a good night, everyone.